You've heard of high net worth, but we're talking about high net purpose. We want to find out how entrepreneurs, global leaders in our network are allocating financial, human, and intellectual capital in pursuit of purpose. But more importantly, we want to understand the compromises, the paradoxes in their approaches, pitch decks, and philosophies. This is the episode we wanted to record from the start. Widely known as the father of both European venture capital and impact investing, we sat down for an in-depth conversation with Sir Ronald Cohen. Having co-founded powerhouse Apax Partners, investing billions across tech, healthcare and consumer, he informed his partners that he wanted to devote his time entirely to what he calls the impact revolution. The idea that every investment decision should optimize for risk, return, and impact on people and planet. His argument is simple but radical. Governments are broke, inequality is rising, and the old model of relying on taxation and philanthropy to solve social problems has failed. The answer is to redirect the trillions already flowing through capital markets by measuring impact the same way we measure profit. What also makes Sir Ronald's story so compelling is where it starts. A refugee child who arrived in London speaking almost no English, made his way to Oxford University and then Harvard, and then rose to the top of an industry that didn't yet exist, and who then chose to spend the next chapter of his life trying to reshape the system he helped build. Finally, we also get to discuss the next bounce of the ball. We get an insight into how AI is changing the next generation of impact investing. This is a Sir Ronald Cohen episode. Sir Ronald Cohen, welcome to High Net Purpose. We're sat here in London in April 2026 at a point of heightened tensions globally in terms of geopolitics. We're seeing a retreat away from sustainable investing, but at the same time, everybody's talking about AI technology and the potential of it and social impact. So if there was any guest that I could think of having today as the father of European venture capital and the father of social impact investing, it's yourself. So thank you for taking the time.
Delighted to be here with you, Joe.
So we will start with the same question, which is, do you have an articulation of your purpose?
Articulation is a strange word in a way, because I think the whole essence of purpose is a feeling. And my feeling is that if you want to find fulfillment, then you don't find it in just doing things for yourself. You find it by a balance between doing things for yourself and doing things for others.
And so that's been a driver of how you think about projects that you take on, and
that's been a driver of my life, in a way. When I got into venture capital, I did so because I wanted to do something that was useful for Britain and for the world at large. At the time, in 1972, I think there were 1 million unemployed in the UK. It was a way of making money. I had to make money, Joe, because my parents came here as refugees from Egypt. I was 11 years old. We lost everything. But I didn't just want to make money.
Yeah,
I wanted, and I was at Oxford, as you know, in the 60s. It was a very idealistic time. I wanted, in today's impact parlance, to do good and to do well at the same time.
Yeah,
to make financial returns, but also to have social impact. And venture capital seemed a good way to do that. And then, as I funded entrepreneurs, I began to realize that actually the social gap between rich and poor wasn't getting any smaller. It was actually increasing as a result of venture capital. And although the people who were lifted up came from nothing, and they benefited their families and their communities as they became wealthy, there had to be a more equitable type of society that we could create. So as I was nearing the age of 60, the age of 53, I said to my partners at Apax, I'm going to leave. at the age of 60, we'll have a constitution for the firm. You'll carry the firm on. I would like to deal with social issues and the Middle East conflict. Well, the Middle East conflict, we don't need to say very much about, as you were saying. We're at the worst point of my lifetime.
But taking a step back before we get into Apax, some of the experiences of your younger life, though, had a determinant as to you having this sort of sense of purpose about helping other people.
I think undoubtedly.
Yeah.
Although I was brought up in a family where you gave to the poor every time anything good happened to you, and 10% was the amount, and so you could say that my parents inculcated in me this a sense of responsibility for others. But leaving Egypt as a refugee, coming here without speaking English, being helped at a wonderful grammar school, albeit not a very prominent one, with an amazing teacher called Richard Farley, who helped me get into Oxford, created a sense in me that I should help others in my turn.
And because you're 11 years of age when you left as a refugee, and then you sort of jumped forward to being president of the Oxford Union, which is a pretty, as a room to go into. Was it that teacher, or was it the family and the concept of tithe and all of that working together that gave you the confidence?
I mean, after the Union, I thought I could do anything. I could do absolutely anything. I was lucky enough to invite Bobby Kennedy,
wow.
To come and speak, and he came. Even today, it's like one of the historic occasions of the Union. I felt I could do anything. I was also taught to be entrepreneurial. My father always said to me, "You shouldn't work for anyone. You should do your own thing." And when I was at Harvard Business School, immediately after Oxford, it was the beginning of entrepreneurship as we know it today. It was the very beginning. Venture capital hadn't really started as a profession. The average size of a venture capital fund when I left Harvard in '69 was at $2.5 million.
Wow.
And so what was in the air was this new idea that young people can achieve anything.
And Europe was pretty a barren landscape for venture at that point?
And Europe at that stage was viewed as barren territory.
Yeah.
Entrepreneurs were all American. In the UK, in Europe generally, if you fell on the way, then you were kicked and and beaten down. Whereas in the US, you were helped up. Entrepreneurship would never work here. Well, that just didn't sound right to me.
I know we're making a giant leap forward through an incredibly successful career as a venture investor, but in your early 50s is when you approached the partners and said, "Look, age 60, I'm out."
Yeah. By the age of 53, I'd done well enough financially that I could see that I would be able to devote my life and my resources to doing something more meaningful than just making money. As I wrote in my book, I didn't want my epitaph to read, "He delivered a 30% IRR."
Yeah.
I aspired to achieve a bit more meaningful objectives.
What was that? When is enough enough? What was it actually a number, or was it that, no, I'm in my 50s and I feel...
When I left Oxford, I thought I needed to make £300,000 to become financially independent.
Yeah.
Right? Now, as you become successful, it's an upward moving escalator. The number gets bigger and bigger. But it had got sufficiently big that I could see that I could live off my wealth, without trouble. So that was enough.
And at that point, had the UK government contacted you to start the work, or?
So there's a big element of luck in all our lives, in yours, like,
sure,
like mine. And in 2000, 5 years before I left Apax, I got a phone call from the Treasury. Gordon Brown was then Chancellor, Tony Blair was Prime Minister, asking me whether I'd look at the issue of poverty with a more entrepreneurial eye, because the phone call went, government's thrown a lot of money at it, but we don't seem to be able to make a dent in it. And whether I would lead a social investment task force to try and come up with some recommendations. Although I was leading Apax and was hugely busy, I said yes. And that task force published a report after 1 year, which you can find on the web, saying, what we've done for people who want to make money by inventing venture capital, we have to do for people who want to improve other people's lives. And the reason we haven't made more progress in tackling issues like poverty is we've relied only on government and philanthropy, not on investment. Well, if you look today, the total philanthropy giving annually is about 2 to 3 trillion. The amount of money in investment markets, as you well know, is 250 trillion. So if you can bring investment to tackle social issues, it seemed to us in 2000, then you make a much bigger dent in it. And so we set out, in a way, a goal, which was to innovate in finance so as to enable this to happen, for money to be attracted to those who want to do good, and not just to do well. And that it would be necessary to create a social investment bank, as we called it, to innovate, to invent some new ways of attracting capital. And that, in a way, set the goal for me that led to the creation of bridges, of social finance, of better society capital, of the Education Outcomes Fund, and so on. And
in your early 50s, had you seen what the solutions could be, or you could just see a kernel of an idea?
No. In 2000, the end of 2000, 4 years before I left Apax, I couldn't see the mechanism. The mechanism became visible 10 years later, after we'd created bridges and then social finance. And 2 youngsters at social finance came up to my office in Portland Place from the basement. We created our startups in basements. Both bridges and social finance were created in basements, not garages as they do in Silicon Valley, and said, what do you think if we tie a reduction in the number of prisoners going back to jail, which is a problem they've been working on, to a financial return for investors? And as would have happened to you if you'd heard that, a light bulb went on in my mind. I said, you've found the key to the capital markets for social entrepreneurs. If we've all assumed we can't measure anything when we're dealing with the societal issues, but we can measure a percentage reduction in the number of prisoners, young prisoners who go back to jail. The number was it still is over 60%, come back within 18 months in the UK and in most countries. You can measure that. And if you can pay according to that measurement, then it's a brilliant mechanism because it gives investors a way of backing people who have social objectives and getting a return if these objectives are achieved.
And that was Peterborough was the first one.
And Peterborough was the first one.
And the path for social investing, it seems that it's, the trend is obviously going up, but it's not been without its challenges. What do you think were the biggest challenges to it, and have some of those challenges actually changed how you think about the model?
It's an interesting question. I think when the first social impact bond, the Peterborough bond, was launched in 2010, my expectation was that government would seize this mechanism with both hands. Because if government committed to pay for social improvement and investors put the money up, you'd begin to get innovation in the way of doing it, and you've shifted the risk from government to the investor.
Yeah.
So it seemed a very obvious thing for government to do. Similarly, philanthropists who had invested in the first social impact bond didn't want to raise any money other than charitable money for the first one, because I didn't want to be accused of helping people make money off the back of prisoners. So they were all foundations. But they didn't grab it either. Markets grabbed it. 10 years later, you began to see the sustainability-linked market develop. Today, it's $1 trillion pool, or it reached $1 trillion pool. It's receded a bit since the Trump administration came in, but still a huge pool of capital, where if a company borrows and achieves preset social or environmental targets, the interest rate it pays falls. So it was completely the opposite of what I had expected. Governments and philanthropists didn't go for paying for outcomes. And financial markets understood its scope and took it way beyond anything I could have dreamt of. If you'd said to me on the day we launched the Peterborough bond in 2010, 15 years later, you'll have $1 trillion pool of securities inspired by the social impact bond, I'd have said unbelievable.
So how do we think? Because we missed a step in terms of how you started to think about risk differently when you went into the venture, and then you've thought about impact differently and how that is added to the equation. But that trade-off, because if we are investing into bonds of a issuing entity and getting a lower rate of return than bonds that they've issued elsewhere in the market, how do we manage that trade-off?
You know, it's a misconception that there needs to be a trade-off. I actually believe that optimizing risk, return, and impact today is the way to deliver a superior return. The reason is that the level of risk that you achieve by taking impacts into consideration is reduced. The risk of carbon taxes or other taxes coming in on employment or the environmental effects or anything else. The risk of consumers moving away from your company's products because they object to the harm that you're causing. The risk of talent leaving for companies that have bigger aspirations and give them, if they're young, much greater meaning in their lives. Secondly, if you look at what technology achieves, what technology achieved in the first revolution was to disrupt every business model, right? The microchip disrupted virtually every business model. Now we have AI doing the same. And where AI meets impact, there's going to be another huge disruption today. So the technology is also enabling new business models that include impact. And Tesla would be the first example of that. If you didn't think impact, you wouldn't create Tesla. If you didn't think environmental impact, you wouldn't create Tesla. You'd miss out on $1 trillion company that was created in 20 years, whatever we may think of Musk's idiosyncrasies. He was the first person to create a major company with impact at its core. So it also obscures the existence, if you don't look at impact, it obscures the existence of opportunities.
But jumping back to the first element of that response was on the the governments and potential for future tax on carbon. A couple of years ago, we put together a climate scenarios session for about 48 hours, looking at a whole range of things into 2040. But one of the insights that came out of it was from some work that we had from En-ROADS and MIT as to what actually moves the dial in terms of reducing carbon emissions and abatement in the future. And it was carbon tax. Everything else hardly touched the surface. It was carbon tax. So do we need to be thinking as investors today that a key premise is that this carbon tax will come in despite what we have with Trump?
32 countries are already levying carbon taxes. 32.
Yes. Yeah.
You know?
Yeah.
Everyone's going to be levying carbon taxes. Everyone. For one thing, they're easier to levy. They're more difficult to evade.
Yeah.
You know, or avoid. So any investor today that does not take into account the possibility of future taxation is missing a major risk.
So data centers, anything like that, where you've got a long time frame, if you're not factoring in that there will be some tax on the carbon emissions at some point, you'll be missing a big part of the equation.
Yeah.
Consumer preferences. So 2025, Edelman did a very good barometer of trust, but they also looked at consumer preferences in terms of whether they're going to be global or getting more national. And they talked about the sort of insularity that the consumer had moved from being worried about climate change and everything else to being more nationalistic and worried about themselves and looking for comfort and things like that. Is that just part of the cycle, or do you think the consumer will revert again?
I think we have to separate the cycle from the trend, and we mustn't confuse the two. We have a political cycle at the moment, which has turned against, the huge progress that had been made in raising environmental issues to the global consciousness. Young people today don't want to work for companies that are polluting the hell out of the atmosphere. Whenever I speak at universities, I ask, how many of you would work today for a company that's highly profitable but polluting the atmosphere in a very serious way? One hand goes out of 100 or 200 people. The sentiment amongst young people, as you know, is very different from that of older generation. Now, I'll just continue to make a point. Young people are beginning to shop now with apps. They point their phone to a barcode on the supermarket shelf, and they can see on their phone the impact on their health or their looks of a product. They can see whether it compares favorably in terms of price with other alternatives and so on. Very soon, they're going to be able to see whether the company that is bringing that product is a big polluter or a lesser polluter.
I sometimes worry that could be in a bubble, in that, we're talking to university students, we're talking to people who may have some more choice in this versus the wider population and the global South who don't maybe have the opportunity to be able to price that and choose to go for something that's less damaging.
But climate change is visible to all.
Yeah.
Right? And if you're young today and you wonder about the world you're going to be living in and your children are going to be living in, prudentially, forget morally, prudentially, you must be asking yourself, am I being an idiot by buying the products of a company that's going to make the lifespan of my family shorter?
So I'd love to go back to the technology and how AI is changing what you're doing. When did the impact weighted accounting start as something serious for you?
So it's a very, very good question. The need for it arose as a result of the work we did on the G8 Social Impact Investment Task Force. in 2013-14. This was about 4 years after the first social impact bond. And what we discovered and I should explain, the Cameron government, which followed the Blair Brown government, the Cameron government asked me to take the work of the Social Impact Investment Task Force, if you like, of 2000 globally, to take this idea of impact investment globally. And we began to analyze in each one of the G7 countries plus Australia what was happening. And we saw ESG investing, this new phenomenon, which had already reached $13 trillion. Of course, it got to 30 trillion 10 years later. And it occurred to us then, the world is moving in the direction of the social impact bond. It's trying to optimize risk, return, and impact. But there's no measurement of impact. And there was a report written then on basically on impact accounting and the need to measure impact in ways that resemble our measurement of profits. So 2-3 years later, I bumped into Professor George Serafin, professor of accounting at Harvard Business School, where I sat on the board's dean of advisors, coming out of a meeting. And I asked him, tell me, George, do you think we can bring impacts into financial analysis and the valuation of companies? He said to me, absolutely. I said, okay, let's go for it. And that's what we've achieved since 2017, over a period of 8 years. We've shown how you can turn the tons of carbon, the liters of water, the acres of soil erosion, the tons of waste, and even the differences in pay and training and ethnic representation or gender representation into monetary terms. And this year will be a watershed year because I expect in the middle of this year, for the first time, to be able to see on the screens of the data providers, at least one data provider, monetized data about 16,000 companies' emissions. So for the first time, you will have a price for water consumption or water pollution in 268 different parts of the world, or for emissions first and then water subsequently. You will have a price for emissions in different parts of the world. And we've shown how impact accounting is going to work. You basically, because of AI and machine learning, are able to put together a set of 100,000 value factors today, covering the whole of the globe, and all in the case of not what will appear this year, but the initial publication of the value factors, covering all of the environmental factors that I referred to: emissions, water, erosion, and waste. And on a computer screen, you can pull out the metrics in terms of quantities, and you can match them in terms of location with the facilities of a company, and arrive at a cost, which then goes into your P&L. And so you get to impact-weighted earnings per share, impact-weighted PE ratios, correlations between emissions and growth of sales and profits, and so on.
Because was the sort of previous, I don't know, if do we call it ESG 1.0 or whatever, they were, investors were we're building this in, but without sufficient information, and it was what company was better able to manage its disclosures and, hire the right person to put, whatever went into their year-end impact report.
So there's a striking historical parallel, Joe.
Yeah.
After the Wall Street crash of 29, investors sat up and said, we've been investing without understanding what profits companies have been making. Each one picks its own account, each company picks its own accounting policies, and there are no auditors to verify the numbers. And actually, companies were allowed then, if you can believe it, to put into a hidden reserve part of their profit without disclosing it to investors. So it's crazy. And you got the introduction of GAAP accounting, which the Roosevelt administration brought in. At the time, people said it will spell the end of American capitalism, right? We know that transparency was crucial to creating the trust to sustain huge financial markets. Same was happening with ESG. Investors were investing to achieve profit and impact, but there was no real knowledge of what impact was being created, and it became a huge problem. Impact accounting turns ESG into impact investment, because the definition of impact investment is that you have the intention to create impact, which ESG had, but you also measure the impact rigorously. And that was in the G8 task force, report.
Because I often think of impact being it's the intentional side of investing, whereas sustainability is more about risk management. So that's a bit of a rough sort of way of looking at it. But we surveyed some of the largest public equity investors last year to ask them a range of questions, and our question, the big one was: is it an impact or illusion being able to invest into public markets? If we're investing into these companies that are listed outside of engagement and proxy voting, do we have any additionality?
Okay, well, that's a very important question. And the answer is that you get the additionality when the company's policies begin to change. When a company begins to realize that 15 or 20% of its shares, ESG got to 15% of investment markets, it begins to worry about how its shareholders are going to perceive its performance. If they're worrying about impact performance as well as profit performance, and the companies begin to measure the impact performance, and then they begin to worry about whether their product lines are going to enable them to maintain growth and profits with changing consumer preferences and so on and so forth, and carbon taxes, and will affect them, and so you don't get additionality from the investment decision to shift from one company to another, but you get additionality from the company that you've shifted out from and the company you've shifted out to, aligning with your objectives.
Because we saw that with the survey that it was only about 10-15% of them actually saw additionality. It was the conditional side. So there was a big group of, even though sustainability focused investors, who were saying we're skeptical about whether it is, but that conditional line, I think, is what you're describing. But I am going back to the impact weighted accounting methodology. So if it's not specifically getting additionality, but it's giving us an opportunity to invest longer term into better companies, you look at this stuff in a sector context, right? So it's looking at comparability between intra-company, intersector companies. So an example would be what?
Say in the mining industry, you will find huge discrepancy in emissions and water consumption between leaders and laggards. You'll find the same to a lesser extent in the aircraft industry. You'll find it in the chemical industry, in the building industry. One of the insights that you get from having transparency, full transparency on impact, is that there are leaders and laggards already. Everybody's not at the bottom of the pile, actually. And when the leaders' superior performance is revealed, they benefit. They benefit from it, and the laggards obviously suffer. So the transparency in itself is going to be a major driver, in my view, of improved impact.
But it's, I guess it's highlighting what the management team are like, how they think about their businesses as well, and how they run them, which you can't see from the outside.
Yeah, but measurement has great power to influence decision making.
Yeah.
And again, there's a fantastic historical parallel which relates to my own life. When I got into the venture capital business, I didn't realize that what would drive the growth in portfolios of venture capital and other alternative asset classes was the fact that the measurement of risk had started in the 50s at the University of Chicago, when Professor Harry Markowitz and his colleagues began to say, risk's always been there. Why do we measure it? We can just look at how much a stock goes up and down, its volatility. That's going to be the measure of its risk.
Yep.
The measure of impact will do the same.
And AI is a key part in the sort of breakthrough for this next stage.
Without AI, we would not have been able to do what we did in the International Foundation for Measuring Impacts. Yeah.
Okay. So you think it's going to be the middle to later this year on our Bloombergs and everything else, we'll be able to pull down this data and get the transparency that we need?
I haven't mentioned the data provider, but hopefully. Yeah.
Okay. Now we've touched on AI. The societal side of what you look at. So we've talked a bit more. I know we talked about Peterborough earlier on, but we've been talking more about emissions and water and the rest of it. When it comes to the social impact of businesses, is that where it gets a bit murky and muddy and difficult again?
Not really. We actually started out the impact-weighted accounts initiative with social rather than environmental factors. Because society was uppermost in our minds then. It should still be uppermost in our minds alongside environmental today, but the political cycle we were referring to sort of made it a bit unfashionable to talk about things like diversity and so on. But if you want to measure today the pay level of a company relative to the living wage or the minimum wage or the average in its sector or the top quartile or decile of its peers, that information is available. In many countries, in the US, it's fully available. In Europe, there are issues about privacy law and so on. But broadly, that information is available. If you want to start thinking about advancement or representation in the workforce of different gender groups or different ethnic groups, you can do that too. What we assumed was that the economic cost to a community of not having one of its members employed is the salary they would have earned, right? So you can, through AI, measure the employment within an Amazon facility and the community around it, similarly with an Apple facility. You can look at the difference between the two, and you can ascribe remuneration levels according to the remuneration level of the company. You come out with a number. Amazon, $6.5 billion a year diversity deficit. Apple, $2.5 billion a year. As a percentage of wages, Amazon 16%, Apple 25%. Now, you then have to go away and think about what you do with that information as an investor. But it begins to create an environment for measuring impact performance that's similar to the one that we have for profit. So social will follow, shortly after environmental.
And with AI, we should be able to capture more of the data insights backward looking so that we can actually, underwrite some of the hypothesis that we're talking about here, right? Because that is the missing bit, isn't it? It feels like how can we confidently say that score versus this other score means that this company will be way down in the medium to long term by not scoring well on that?
Yeah, I mean, so far we've relied on ratings, right? Different companies have provided ratings. You can't really bring ratings into financial analysis. You need values.
Yeah.
There's another aspect that's very important psychologically, which is that if you speak of tons of carbon, you can't relate their importance psychologically. We don't know how to absorb the importance of a million tons of carbon versus 10 million tons of carbon. When you turn it into money that's relatable to profits, all of a sudden you understand that there's a measure that you can understand. And so I think the monetization of impacts is actually going to lead to a lot greater understanding of the impacts that companies are actually creating, and therefore the measurement of an investment portfolio invested in those companies, or a fund for that matter. These numbers, monetized numbers, will also relate to funds. You'll be able to look at the impact performance of funds relative to one another.
Because when we look at a lot of sustainability funds, the top 10 holdings will have a handful of Mag 7 companies in there. And there will be a good explanation as to sort of why, and that they're buying shares and they're engaging with management to change what they're doing.
Yeah.
But do you think the more interesting stuff will be in that mid-cap end of the market, or it doesn't work that way?
Technology has revolutionized business in the last 50 years, and it can revolutionize them just as greater, even more greatly in the next 50 years. The process of revolution tends to go through the innovation that is brought by young companies that grow to, some of them, to dominate their markets and disrupt a whole industry. The same thing is happening already with AI. Now, the powerful thing for me about AI is that it meets impact, obviously in positive and negative ways, but it makes possible the delivery of positive impact in ways humanity could never conceive of previously. In a field like education, you can now conceive of having 1 million lessons taught individually across the world simultaneously. When could humanity contemplate doing something like that? In health, you can think in terms of health diagnosis across the whole world. In health research, of course, we've seen the first drug emerge from the greater capability of AI to make connections between different fields. So where impact meets AI is where the huge new opportunities are going to be. So it's fine to take a snapshot today of companies' impact performance. But what we're really interested in is to have a vision about the impact performance of companies in the future, because a lot of the innovation is going to be driven in the direction of doing good and doing well at the same time. I know that because I have a portfolio of more than 30 impact ventures. Early stage seed, A, B, C. The most inspiring entrepreneurs aspire to do good and not just to do well. Whereas a software company in the transport field, catering for cities, would, in old times, simply have measured the growth of its sales and profits. Today, a company like Optibus is measuring its emissions, optimizing size of vehicle and emissions to peak demand, optimizing the routes, measuring commuter time, which hits more vulnerable population, measuring number of hours worked by the drivers, measuring number of accidents.
Yeah.
The dashboard of the company is different. Now, you think of companies competing with Optibus that are going to a mayor and saying, oh, we have great software for you, but we're not worried about all these highfalutin things. They'll be at a disadvantage. So you're going to find companies competing, as did Tesla, on the basis of profit and impact.
So if you were advising entrepreneurs or families on how they can have the most purposeful impact in what they're doing on the investment side, what do you think the key decisions that you think that they need to make?
I think the first thing is to realize that impact is going to be like technology has been. If you don't embrace it, you're going to be left behind. That's the first thing. So this is not a luxury. This is a necessity for you. If you own coal mines, you've been hit already. You own fossil fuels, sure, we've gone through very high prices, but now the world's beginning to realize that for completely different geopolitical reasons, maybe we'd rather be self-reliant by having solar energy and wind energy than importing oil from distant countries.
Yeah.
And then you have the incidence of taxation. So how do you approach bringing impact into your portfolio? Impact today is accessed in different asset classes. You can access it through private equity funds or venture capital funds that are impact-driven. Interestingly, TPG, a very prominent private equity firm, as you know, manages 30 trillion of impact funds now.
Wow.
No, not trillion, billion. 30 billion of impact funds. I mean, this is no longer, $100 million impact fund that that we're talking about. You will find some impact real estate funds. They're focusing on more efficient buildings environmentally, but they're also focusing on social housing and so on. Within the quoted markets, you will find some companies that are in areas like education, health, carbon capture, and so on, which are naturally positive impact industries.
Yeah.
You have to look more carefully at the price levels of their products to see whether they're affordable for everyone and before you can make a judgment about their impact. But you can begin to look at your whole portfolio with an impact lens. And that's what you need to do.
So it's not a luxury. It's something you need to build in at the portfolio level. And you also spoke earlier about, I think, with some of the entrepreneurs in the ventures that you backed, you're looking for the signal information that the entrepreneur is thinking about this. And if they're not, it's going to be a big missing part of the puzzle. What about where to go to? Because there's 60 plus different organizations in and around sustainability, and I get completely blinded by it. Are there some places that you would recommend that you would say these places are the right places in terms of information and quality of network?
I think we're about to go through a revolution of, sort of the quality of the offerings of companies that are in the field. Many of them have been pioneers of the field, and they've helped us get to where we are today. We didn't have the technology 25, 30 years ago that we have today, so we couldn't analyze, as we've been saying. I think many of these, I know from personal experience, many of these organizations are focused on the arrival of monetized information and what their role is going to be in that ecosystem. Now, there is going to be a shift from having a number of competing standards for measurement, for example, to a single standard.
So it feels like this is a transition point for a lot of these organizations as well, and it's hard to be drawn on who are going to really lead from this point. But this is a integral year for a lot of this stuff to come out. And I guess when you do have periods of the crisis with what's happening with the Trump administration, all the rest, it makes people work even harder to find the solutions.
I think there's going to be another element, Joe. Governments are cash-strapped today. More money is going to defense spending than has previously gone. People are beginning to realize that the shaking up of our democracies has come from huge differences in income and wealth, and that there's a need now to close these. Like the differences are now greater than they were in 1929, right? So governments are going to begin to measure outcomes. Governments are going to begin to say, we're not just going to put billions into education, we're going to put billions into education. We expect so many people to graduate with these attainment levels, and these numbers have to be met. And they're going to begin to say, we don't have money to do all of that, so we're going to promise to pay for these outcomes. Here's our price list. You get young woman to attainment level of so much, such a level in a different country or your own country or whatever, and we're prepared to pay you so much for that. On the basis of that promise to pay, investors will come in, like sustainability-linked bonds, and say, fine, we're prepared to fund the organizations that can achieve improvement in education. And so here in the UK, we see the creation now of a £500 million central government outcomes payments fund, right, for children, to be matched by a similar amount from local authorities and philanthropists, so £1 billion. As governments begin to measure outcomes, the notion that it's valuable to measure is going to become commonplace. And so, for example, these apps that I was referring to Yuka, the French app, which is now used in several countries, mainly in France and the US, by 50 million people to shop. The idea that these apps measure outcomes, and that's the right thing to do, is going to become much more widely spread. So we're shifting to a world where everyone begins to, and that's what impact is about, right? Everyone begins to realize we have to worry about the outcomes we're creating, not just the money we're making. And actually, it's a better way to make money. And it doesn't just affect one sector. It affects business, it affects investment, it affects philanthropy, it affects government, it affects entrepreneurship. It's systemic. And at the end of the day, what's driving it? What's driving it is a sense that we can't continue as we're doing. If we want to tackle our environmental issues, we have to get our economies to generate the solutions. If we want to reduce the gaps within our society, we have to get companies to help to achieve that. We have to get our whole economies now to worry about outcomes, not just about profits. So that's why I think it's a watershed moment. And if you're a family-owned business today, or if you have a family office, and your wealth has come from a family-owned business, you probably started with a lot of these values, or your grandparents started your companies with a lot of these values, because family-owned businesses were always more concerned about outcomes for their communities, for their employees, for the environment, than public companies where the shareholder is less present.
Well, it's a great note to start to come to the conclusion of our conversation. We usually finish with the same two questions, which is if you're able to give some advice to a younger version of yourself, maybe leaving Oxford way back when, what would it be?
I think I would still give the advice I gave in my first book, The Second Bounce of the Ball. Start young, think big, and stick with it. But I would add to that today and bring impact to whatever you decide to do. If you're an entrepreneur, bring it to your business model. If you're going to work for a big company, pick a company that is concerned about impact. If you're going to be in government, try and put yourself in a position where you can help improve outcomes.
Well, thankfully, I was one of the recipients of that advice back in 2007 when you gave a talk at Exeter College at Oxford, and it was a real push for me to have founded Island Bridge. So I wanted to say thank you again for that then. And then the very last question is, how do you keep healthy and well?
Impact.
But you
have a new book. The second version of Impact has just been published. It has an additional chapter on the interaction between society, government, and an impact economy. I'm passionate about the impact. I'm passionate about trying to sort out the problems in the Middle East. I'm stimulated by the younger generation. I see huge potential. Of course, I see risks as well. Technology isn't good or bad in itself. It's the use that human beings make of it that is the real risk. So these things concern me, but I'm optimistic about the future and passionate about what I'm doing. So I guess that's what keeps me going.
That's the well, because your energy and optimism is infectious. It's been hard to capture in the minutes that we have today the full extent of what we could have had a full conversation on bridges, on Portland, at a whole range of the different successes and super interesting periods that you've been pivotal in the last few years. So I guess finally say thank you for your time today, spending with us and taking us through what you have, and thank you for what you do more generally.
Thank you, Joe, and thank you for all the efforts you're making to make the world a better place.
All content on High Net Purpose is provided as general information only. It does not constitute any advice, recommendation, or representations, and is not intended to influence listeners or users into making any specific investments or any other decisions. Please be aware that guests and presenters on High Net Purpose may have investments in any of the topics or products being discussed. Their reviews and opinions are their own and should not be taken as endorsements or financial advice. Before making financial decisions, we strongly recommend seeking advice from a qualified financial professional. This podcast may not be copied, reproduced, further distributed, or published in whole or part.